Hey everyone, today we're diving into a deal rumor that could shake up the beauty industry. Estée Lauder in talks to potentially merge with Puig. I want to break down what this could mean, not just for the two companies, but for brands, markets, and the bigger narrative of how mega cosmetics power is evolving. Let's unpack with a fresh perspective, not just a recap. First, a quick setup. Estée Lauder Companies, a titan in prestige beauty, has been navigating a tough patch, tariffs, supply chain headaches, and a broad restructuring under its Beauty Reimagined plan. Puig, a strong European player with a portfolio that includes Charlotte Tilbury, Jean Paul Gaultier, and Rabanne, represents a different kind of value, diversified brand access, regional strength, and a roster of iconic names. The market reaction was telling. EL shares slid around 8% on the news, while Puig edged higher. That tension between potential upside and risk is not accidental, it's the signal of what a merger, if it happens, would be trying to balance. Now, let's get into the core ideas and my read on what matters here, with plenty of commentary along the way. Idea 1, the strategic rationale, combining scales, not just brands. Personally, I think the core attraction isn't simply two big beauty names merge. It's about stitching together complementary strengths, Estée Lauder's global reach, supply chain efficiency, and premium marketing machine with Puig's European depth, brand portfolio flexibility, and potential cross-cultural appeal in growth markets. What makes this really interesting is that scale in beauty isn't just about bigger warehouses, it's about data, consumer insight, and the ability to move complex, sometimes fragile products across high-velocity channels. From my perspective, the deal could unlock faster product-to-market cycles, better regional landing pages for launches, and a more resilient margin profile if they can harmonize SKUs and pricing discipline. A detail I find fascinating is how tariff exposure might be addressed more cleanly through a unified sourcing network and shared logistics, potentially softening some of the profitability hits EL has shouldered this year. Idea 2, brand portfolio dynamics, how do you integrate without diluting? In my opinion, Puig brings a mix of edgy, fashion-forward, and fragrance-led brands that could complement Estée Lauder's more traditional prestige lineup. But there's a caution, fans of Charlotte Tilbury, for instance, might care deeply about the stewardship of that brand's identity post-merger. What many people don't realize is that brand stewardship in a merger isn't just about keeping logos, it's about preserving tone, storytelling cadence, and the founder's voice, even when that founder isn't directly involved. If the two groups can preserve unique brand identities while enabling cross-brand collaboration, think limited edition capsule drops and shared retail experiences, they could actually create more consumer intrigue rather than brand fatigue. This raises a deeper question, will the combined entity risk losing the tone that drew customers in the first place, or can it curate a richer ecosystem where each label still speaks clearly to its core audience? Idea 3, financials and timing, what the market is really signaling. The market's reaction, EL down around 8%, Puig up about 3%, suggests investors see potential upside but remain cautious about execution risk. In my view, the most critical levers will be cost synergies, integration timelines, and how tariff protections are baked into the forecast. The reported lack of disclosed financial details makes it hard to model precisely, but the backdrop matters. EL's guidance pointed to a roughly $100 million hit from tariffs in the full year, a number that could be meaningfully reduced if the merger unlocks a more efficient tariff strategy or a restructured supply chain. What this implies, if the merger happens, we'll want to see a clear plan with measurable milestones, how many headcount overlaps to eliminate, which SG&A costs to consolidate, and which markets gain the fastest revenue uplift. People often overlook the importance of integration culture here. Even the best financials can flop if the teams don't align on decision-making and brand stewardship. Idea 4, market structure and competitive landscape, where does a merged EL Puig fit? A merged entity would not only compete with other prestige players like L'Oréal, Coty, and Unilever's prestige divisions, but also with indie brands and direct-to-consumer challengers nipping at margins. In my view, the key advantage could be a more diversified geographic footprint, with stronger footholds in Europe and Asia-Pacific, plus a blended portfolio that can test rapid-fire product cycles without losing the premium aura. What makes this interesting is how digital channels could be leveraged more aggressively, joint loyalty programs, shared e-commerce tech, and cross-brand storytelling campaigns that still respect each label's DNA. A frequent misunderstanding is assuming more brands always mean more complexity. In reality, the right tech integrations and a unified data strategy could simplify customer journeys and tailor experiences at scale. Idea 5, the turnaround angle. Can this accelerate refurbishment or slow it down? Estée Lauder's Beauty Reimagined plan aims to revitalize performance amid headwinds. A strategic merger could be a speed boost if it accelerates new product development, channels modernization, and efficiency gains. On the flip side, integration can sap energy and derail the turnaround if it becomes a distraction. What this really suggests is a delicate balance. The company would need to maintain momentum on its internal reform while simultaneously weaving in Puig's capabilities. The deeper implication is about corporate resilience. The industry is recalibrating toward more resilient, data-driven, globally integrated models, and this could be a case study in whether a consolidation as threat to turnaround or consolidation as accelerator plays out. Deeper insight, beyond the numbers, this signals a broader trend in beauty, ownership consolidation as a route to stronger regional versatility and innovation velocity. If we zoom out, you can see a world where megabrands don't just chase prestige but also create ecosystems of collaborations, limited editions, and co-branded experiences that blur the lines between fashion, fragrance, and skincare. The human angle matters here too. A merged entity could offer more robust career opportunities across geographies, but it could also squeeze smaller teams if synergies are overly aggressive. The real question is what kind of culture will emerge, one that preserves creative risk-taking or one that borrows too heavily from corporate playbooks. Closing thought, the real test isn't whether the deal happens, but what it enables. If they can fuse EL's global scale with Puig's European and fashion-forward energy without muting individual brand voices, we might see a fresh era of premium beauty that's more agile, more global, and more imaginative. But if the integration becomes a cost-cutting sprint at the expense of brand magic, we could end up with broader access to capital but narrower consumer appeal. My question for you all, do you think this merger would lead to a more vibrant prestige beauty scene, or a less adventurous one? What brands or product categories would you want to see thrive in a combined portfolio? Share your take in the comments, and if you enjoyed this kind of forward-looking breakdown, subscribe for more analysis on where the beauty industry is headed next.